Hey traders! Ever placed a trade because the stochastic said oversold, only to watch the price continue to crash? Or got a bullish crossover that immediately reversed? You're not alone. The stochastic oscillator is one of the most popular and most misunderstood indicators out there. Today, we're not just learning what the stochastic is. This is a masterclass. We're going deep to learn how to read it, when to trust it, and, most importantly, how to combine it with other tools so you can spot high probability entries and avoid those brutal false signals. Let's get into it. At its heart, the stochastic oscillator, developed by George Lane in the 1950s, is a momentum indicator. It doesn't track price directly. It tracks the speed and momentum of price. Think of it like this. In a rocket's ascent, even if it's still going up, the moment the speed starts to slow, that's a warning. Stochastic aims to spot that slowing momentum before the price reverses. The magic formula is simple. Where is the current closing price relative to its recent price range? A reading of 80 means the close is near the top of its recent range. 20 means it's near the bottom. That's where the famous overbought and oversold levels come from. But here's masterclass point number 1. Overbought does not automatically mean sell. In a strong uptrend, an asset can stay overbought for weeks. Oversold doesn't mean buy in a crashing market. This is the biggest mistake beginners make. Open your stochastic and you'll see 3 numbers: %K period, %K smoothing, and %D smoothing. The default is often 14, 3, 3. But for this masterclass, I want you to try 5, 3, 3. Why? The standard 14 is slow. A 5-period stochastic is more sensitive. It gives you signals earlier and helps you see the momentum shifts more clearly. We'll manage the extra noise with our rules later. You also see 2 lines. %K, blue, fast line. The raw momentum value. %D, red, slow line. A simple moving average of %K. It's the signal line. The crossover of these 2 lines is a classic signal. But alone, it's unreliable. Let's fix that. Here's where we separate basic knowledge from masterclass execution. We use these 3 signals together. 1. Divergence, the king of signals. Bearish divergence, price makes a new high, but stochastic makes a lower high. Momentum is fading. This is a powerful warning of a potential reversal. The opposite is bullish divergence. Price makes a new low, stochastic makes a higher low. Divergence is your number 1 reason to pay attention. Don't just buy any oversold crossover. Buy only when stochastic is in oversold below 20 line and the %K line crosses above the %D line. And it happens after a bullish divergence or during a pullback in an uptrend. Reverse for overbought, above 80 line, sell signals. This is gold. Lane himself said this was his favorite. Bull setup. Stochastic falls below 20, rises back above. On the next pullback, it holds above 20. When it turns up from that level, that's your long signal. It shows sellers have lost control. Bear setup, the opposite. Stochastic goes above 80, falls back below. On the next bounce, it holds below 80. When it turns down from there, it's a short signal. You could know all that and still fail. This is the master key. The stochastic is a supporting actor, not the lead. You must filter its signals with trend direction. Use a simple 20-period or 50-period EMA on your main chart. In an uptrend, only take long stochastic signals. Ignore overbought readings. In a downtrend, only take short signals. Trend is your filter number 1. Support and resistance. Is that oversold signal happening at a strong historical support level? That's a high probability buy. Is an overbought signal at a major resistance? High probability sell. Volume or another indicator, pair it with the RSI for double momentum confirmation, or use MACD for trend momentum alignment. 1 signal is a hint, 2 signals are a plan. Let's see this live. Look here, trend filter, the price is above the 50 EMA, overall bias is upper side. Signal, we see a pullback. Stochastic dips into oversold, below 20. Bull setup, check, it pops out of oversold, and on the next small pullback, it's holding above 20. Nice. Confirmation, this pullback is also touching our rising trendline support. Bingo. Entry, we wait for the %K to cross above %D here, above the 20 level. That's our high probability entry. Stop loss below the recent swing low. See how we layered it? Trend, level, stochastic setup, crossover. That's a professional's approach. And that's your Stochastic Oscillator Masterclass. Remember, it's a momentum gauge, not a crystal ball. Divergence is your strongest signal. Never use it alone. Always filter with trend and key levels. Your action step. Go to your charts. Change your settings to 5.3.3. Look for the bull to bear setups and divergences in the context of the trend. Paper trade this for a week. If this video added massive value to your trading, do two things for me. Smash that like button. It helps the channel immensely. Subscribe and hit the bell because next week we're doing a masterclass on the MACD and how to combine it with the stochastic for a killer strategy. Let me know in the comments, what's your biggest aha moment from this video? Is it the bull-bear setups or using the trend as a filter? Thanks for watching, and remember, trade smart, stay disciplined, see you in the next one.